SoFi stock analysis and trade setup. Must watch. Before July 10th, welcome back to Smart Stock Sam. Today, I am walking you through a complete SoFi stock analysis and trade setup that you genuinely need to watch before July 10th, because there is a very specific mechanical event brewing in the options market that could send this stock moving hard in one direction or the other. Here is the roadmap. We are going to expose the massive gap between SoFi's fundamentals and its stock price, walk through who is quietly buying and who is selling, break down a structural trap forming inside the options chain, and then hand you a precise trade setup, complete with entries, targets, and a strict stop loss, plus the one hidden ceiling that could cap this entire rally before it even gets started. So grab a coffee, settle in, and let's get into it. Let's start by establishing exactly what we are dealing with. The core thesis on SoFi right now is that this is a fundamental powerhouse trapped inside a sentiment-driven consolidation. Think about that for a second. On one side, you have a genuine disconnect, a record-breaking quarter completely overshadowed by flat forward guidance and some very aggressive short seller allegations. On the other side, you have what I can only describe as an options powder keg. We are talking about short interest sitting above 15%, colliding head-on with a flood of call option buying, and that combination is priming this stock for something traders call a delta hedge trap. Stick with me, because by the end of this video, we are mapping out a precise, actionable trade setup targeting the July 10th expiration, complete with defined entries, strict risk limits, and exact liquidity targets. But before we get there, is there a hidden ceiling that could quietly cap this entire move? There actually is, and odds are you have not heard about it anywhere else. We will uncover it later in this video. Now here is where the numbers get almost hard to believe. On one side, you have market reality. On the other, fundamental reality. And right now, those two things could not be further apart. SoFi has suffered a brutal decline of 30 to 45% so far this year. It dropped from a 52-week high of $32.73 all the way down to a low of $14.92, and it is currently hovering around $18.24. Now flip to the other side of the ledger, because this crash happened despite SoFi delivering its strongest quarter on record. We are talking about record-adjusted net revenue of $1.1 billion, up 41% year-over-year. Adjusted EBITDA came in at $340 million, up 62% year-over-year. Their membership base exploded to 14.7 million users, a jump of 35%. And net income? It more than doubled, landing at $166,700,000. Ask yourself this. How often do you actually see a company double its net income while the market strips away a third of its valuation in the same breath? It is rare, and that rarity alone should have your full attention right now. So why the disconnect? Because what is actually driving this price action is a vicious tug-of-war between two very different stories. In the bull corner, you have real GAAP profitability, proving sustainable bottom-line execution instead of just top-line hype. You have genuine product expansion, like the rollout of small business lending up to $250,000, deepening SoFi's ability to cross-sell into its existing member base. And there is growing speculation that SoFi has quietly met the profitability criteria required for inclusion in the S&P 500, a move that would force index funds to buy the stock automatically. But in the red corner, the bears have real teeth. Management refused to raise their full-year 2026 revenue projections, handing growth investors a conservative outlook that landed like a gut punch. Their technology platform segment saw revenue decline 27% year-over-year after losing a major client. And perhaps most damaging of all, a short seller report released in March alleged a $312 million unrecorded debt misstatement and raised serious questions about SoFi's fair value accounting. SoFi has firmly denied every allegation, but here is the question worth sitting with. Does the truth actually have to win for the damage to already be done? Rarely does it happen that cleanly. Despite all that noise, SoFi is not sitting still. They are systematically building out what I would call their everything app ecosystem, designed to capture every possible financial demographic under one roof. This is not the student loan refinancing company you remember from years ago. They acquired Composer and launched Composer by SoFi, an AI-powered platform that lets retail investors build automated trading strategies using nothing but plain natural language. They rolled out that fixed-rate small business lending we just talked about. On the business-to-business side, they acquired Peach Finance's cloud platform along with assets from Primary Bid to strengthen their back-end infrastructure. And they are even wading into government programs in crypto, participating in the federal Trump Accounts program, and launching their very own stablecoin, SoFi USD. Piece by piece, they are building something that looks a lot less like a lender and a lot more like a genuine financial fortress. Now, when the fundamentals and the price action disagree this loudly, the smartest thing you can do is follow the money. Institutional ownership currently sits around 38.43%, and we are seeing some very targeted rebalancing beneath the surface. But here is the detail that should genuinely catch your attention. The CEO, Anthony Noto, is showing massive personal conviction. He bought more than 15,000 shares on the open market at $16 in May, then added nearly 14,000 more shares at $18.06 in June. His total direct ownership now stands at 11.96 million shares. When was the last time you saw a CEO buying this aggressively into weakness? It almost never happens, and it is rarely a coincidence. Cathie Wood's ARK fund also reversed a prior sale, buying nearly 300,000 shares, worth about $5.5 million, right as the small business loan platform launched. On the flip side, Acorn Financial slashed its position by 89%, and there was some insider selling from the CTO and the EVP. But before you panic, those sales were executed under prearranged Rule 10b-5-1 plans, or simply for tax withholding, not because executives are quietly heading for the exits. So what does Wall Street actually think? Predictably, Wall Street is split. The current consensus rating sits at a cautious hold, with an average price target of $22.56. But look at the full spectrum, and you will find a heavy cluster of bears sitting between $16 and $18. Firms like KBW maintain an underperform rating at $16, arguing SoFi is, at its core, just a lending business dressed up in fintech language. Truist, TD Cowen, and Barclays cluster around $17 to $18, largely due to weakness inside the tech platform segment. But then you have bullish outliers like Citizens JMP, holding an outperform rating with a $30 price target, highlighting SoFi's rare ability to convert top-line growth into real bottom-line earnings. With the stock trading around $18.24, the gap to that average target alone is significant. So which side is actually right? That is exactly what the charts and options market are about to help us answer. Let's step away from the fundamentals for a moment and look at what the charts are actually saying, because technically, SoFi is currently flashing an aggregated strong buy signal across daily gauges. The stock is rebounding out of oversold territory and is currently sandwiched between short-term support and long-term resistance. It is trading above its 20-day, 50-day, and 100-day simple moving averages, with that 100-day average sitting at $17.53. However, it is still fighting the heavier 200-day simple moving average, which sits somewhere between $19.84 and $22.49. The 14-day RSI is sitting at 52.9, which is about as neutral as it gets. That means this stock is neither overbought nor oversold, and it genuinely has room to run in either direction. And the MACD indicator just crossed to 0.08, officially triggering a mechanical buy signal. But a clean chart alone rarely sparks a massive rally on its own. For that, you need fuel, and the options market is currently supplying a surplus of it. This is where things get genuinely explosive, because elevated short interest is colliding head-on with highly aggressive call buying, creating serious mechanical friction underneath this stock. Right now, 15.55% of SoFi's entire float is sold short. That is roughly 195.79 million shares actively betting against this company. The days to cover ratio sits at 2.6, and nearly 48.5% of that short volume is happening quietly, off exchange, inside dark pools. But here is the trap forming on the other side. Retail and institutional traders are hammering call options. In early July, somewhere between 73 and 76% of all options volume was calls. 30-day implied volatility sits in the 80th percentile at 67.5. Picture it this way. The shorts are trapped in a room and the options market just lit a match at the door. So where exactly might this ignite? Let's map out the open interest for the July 10th expiration, because there are some genuinely massive liquidity magnets acting like an upward gravitational pull on this stock. There is an enormous concentration of call options sitting at the $19 and $20 strike prices. We are looking at 13,680 call contracts at $19 and a massive 18,474 call contracts sitting at the $20 strike. That $20 level is the primary liquidity magnet in the near term. On the downside, put support is localized between $12.50 and $15, acting as a floor with around 4,500 to 5,200 contracts. Now let me walk you through exactly how a delta hedge trap works, because if you do not understand this mechanism, you are trading blind. Step 1. The stock cleanly breaks through the near-term resistance zone between $18.50 and $18.68. Step 2. Gamma exposure kicks in. Those 32,000 combined call contracts sitting at the $19 and $20 strikes rapidly move in the money, or very close to it. Step 3. Forced hedging begins. The institutions and market makers who originally sold those call options to retail traders suddenly find themselves holding massive risk on their books, and to stay delta neutral, they are mathematically forced to buy SoFi shares directly on the open market. Step 4. The squeeze accelerates. That wave of forced buying slams straight into a market where roughly 195 million shares are already sold short. Shorts start panicking, they scramble to cover their positions, and the price violently accelerates toward that $20 liquidity magnet. Will it actually play out this cleanly, step by step? Markets almost never move in perfectly straight lines, but the mechanical ingredients for exactly this scenario are sitting on the table right now. So, knowing that entire sequence, let's build a highly specific, highly actionable trade around it. Here is the plan for a July 10th long position. We want to leverage existing moving average support to set up a genuinely favorable risk-to-reward ratio. For your entry zone, look to initiate positions on a slight pullback into the range between $17.50 and $17.85. That range lines up almost perfectly with the 100-day moving average support at $17.53. Do not chase green candles here, let the stock come to you. For risk management, this part is non-negotiable. Set a hard daily close stop loss at $16 even. That level aligns with recent strong technical support and the lower boundary of recent consolidation. If SoFi closes a trading day below $16, the short-term bullish thesis is invalidated and you exit. No exceptions. No second-guessing yourself. Now, if this trade triggers and support holds, here is exactly where you take profit and the one level you absolutely need to respect. Your first target sits between $18.50 and $18.68. This is the primary resistance zone the stock has recently struggled to break through, so lock in partial profits right here. Your second target is $20 even. This is the secondary resistance zone, and it is exactly where that massive July open interest is sitting. Now remember that hidden ceiling I mentioned earlier? Here it is. The hard ceiling on this stock is $22.41. Why that specific number? Because SoFi carries $428 million in zero-coupon convertible notes due in 2026, and those notes convert into stock at exactly $22.41. If the stock ever reaches that level, note holders can convert their debt directly into equity, creating an immediate and very real dilution risk that will likely cap this stock's upward momentum right there. Respect that ceiling. It is not a suggestion, it is baked into the math. But what if you are not here for a short-term trade? What if you are actually thinking about this as a long-term portfolio holding? Then your eyes need to be locked onto the second quarter 2026 earnings report landing on July 29th. There are 3 metrics that matter more than anything else in that report. First, full-year guidance. Management absolutely has to raise their 2026 adjusted revenue guidance from its current level of $4.655 billion. If they issue another flat, overly conservative update, expect a sharp sell-off regardless of how strong the second quarter numbers actually look on paper. Second, EBITDA margins. Keep a close eye on their progress toward the projected 30 to 37% EBITDA margins targeted for the second half of the year. That is the number that proves real operational leverage, not just growth for growth's sake. Third, tech platform stabilization. We need to see either a genuine reversal or at the very least a bottoming out of that 27% year-over-year revenue decline inside their business-to-business tech segment. Without that, it becomes much harder to justify SoFi trading at a premium valuation compared to traditional banks. Could all 3 line up perfectly on July 29th? Possible, but earnings rarely hand you a clean sweep, so watch each metric individually. So let's bring this all together. Here is the bottom line. SoFi is a genuinely compelling setup right now, but only for those who can stomach the volatility that comes with it. The fundamentals are undeniably strong, the shorts look increasingly trapped, and the options chain is fully primed for a potential squeeze. To recap the full matrix, the current price sits around $18.24, short interest is heavily elevated at 15.55%, and the Wall Street consensus target sits at $22.56. For the short-term trade, look for entries between $17.50 and $17.85. Target $18.68 and then $20, but keep that strict stop loss at $16 and never lose sight of that structural convertible cap sitting at $22.41. Now, before we wrap up, an important note. I am not a licensed financial advisor, and nothing in this video constitutes personalized financial or investment advice. This breakdown is for educational and informational purposes only, built from publicly available data. Markets are unpredictable, every stock carries real risk, and it is entirely possible to lose money trading or investing. Please do your own research or speak with a licensed financial professional before making any investment decisions of your own. With that said, this is a genuinely phenomenal setup to keep on your radar. But remember, the market owes you nothing. Trade the levels, trust the data, and manage your risk above absolutely everything else. Now I want to hear from you. If SoFi breaks cleanly above that $18.68 resistance zone before July 10th, are you buying the breakout, or are you patiently waiting for a pullback into that $17.50 zone instead? Drop your answer in the comments. I read every single one, and I will reply to as many as I can. If this breakdown gave you real clarity on what is actually happening with SoFi, smash that like button. It genuinely helps this channel grow and reach more traders like you. And if you are not subscribed yet to Smart Stock Sam, hit subscribe and turn on notifications so you never miss a setup like this one again. If you got real value out of this video and want to support the channel directly, you can send a super thanks using YouTube's built-in support feature right below this video. Every bit of that support goes straight back into making these breakdowns sharper and more detailed. And finally, if you are serious about leveling up your investing or trading game, I would genuinely love for you to join the Smart Stock Sam membership community. As a member, you get early access to trade setups before they ever go public, priority replies to your personal questions, and custom analysis on stocks you specifically request. It is honestly the best way to get closer, direct guidance straight from me. Thank you for watching all the way to the end. This is Smart Stock Sam, and I will see you in the next one.